Welcome back to Trade 360. I'm Diane King Hall. Time now for the big three stocks, 3 charts, and 3 trades. Kevin Green will take us through the charts, and here to take us through the trades is Jason Brown, founder of thebrownreport.com and author of 5-Year Millionaire. It's great to be with both of you. Jason, before we get into your trades, I want to get your big picture take, how you would characterize where we stand. We're churning today, but what would you say about where we stand now in terms of the market?
I think the churn and the pullback that you're seeing at the retreat from the all-time highs is healthy. However, we still need the broader market to participate if we're going to break through to new highs. Otherwise, you still got two, but three sectors that are pushing it higher. You got tech, you got the industrials, and then you have utilities pushing us higher. But I think we need to see the rest of the market participate if we're going to break through and stay through and get a broad-based rally.
Okay, speaking of a breakthrough, last week Apple certainly had a breakthrough, but it's been an underperformer year to date. So take us through your first trade. Apple's on your list today.
Yeah, so Apple's on my list because much like Reddit, if you remember when I was on and talked about Reddit, how do you know a stock's done going down? When it starts to build that sideways base. And Apple built a sideways base around that 195, 200 level, and then it was hitting resistance around 215. What I love about this stock is a lot of people are counting them out as if they're not going to figure out AI, as if they're not going to figure out an iPhone 17 or 18 for that matter. They had sales up 13% for the most recent quarter. Mac sales was up 15%. And this is all without figuring out AI, without launching a new phone. So it's not a matter of if, to me, it's a matter of when, and you want to be ahead of the stock before that happens. So that's what I like about Apple right here, right now.
Okay, we'll get into more of your strategy in just a moment. KG, what do you notice about this chart?
Yeah, it has definitely been able to break out here over the last couple of trading sessions, and he's exactly right. It was consolidating for a considerable amount of time, not getting a lot of love, but we now see a little bit of enthusiasm when it comes to Apple. This time last year, we were pretty much trading in a very bullish trend to the upside. It does like to trade in these consolidation type of ranges here before trying to break out, and that's exactly what we saw last year when the stock hit up to $260 before kind of breaking back into that consolidation and then breaking below that 200-day moving average, and it's been trading below that moving average pretty much since March of this year. Saw a consolidation, nice little base here between 195 to the downside and about $214. But last week, obviously, we did see a decent little breakout to the upside, breaking above that 200-day moving average. Now, we are at the volume point of control, meaning that the most of the volume over last year is trading around these levels. $228 is that volume point of control, and what you'd like to see is continued increase in volume as well as price action to the upside. And your next area of resistance is going to be around $245. Any type of breakdown that you get, and this could be a decent little check back here, Diane, is going back to that 200-day moving average, which is sitting at around $220. If you come back, retest that, some buyers actually stepping in, that makes it for higher lows as well as potentially higher highs here within the sequence of the breakout. And then to the downside, if we have any failure and go back to about that 195-ish area, that's where buyers once again could step in. So this looks like a pretty decent chart to be able to try to break out here, and hopefully it's able to do so on large volume and then has a well-defined range as it's trying to make higher highs as well as higher lows.
Okay, a decent chart to potentially break out. So Jason, then, given what KG just pointed out, what's your strategy here?
Yeah, and I like that the all-time high, the stock can go up to 260. So you're talking, at least another 34 points from where it's at right now. I think you send this out to June 19th, 2026, long call options. I'm looking at the 210 strike price. You're paying about $37 for that, at least before the market opened. That's what it was. You probably can pick it up a little bit lower now that the stock's down about 2.5 points. Your break even's around 247. What I love about that range is 245-ish is kind of where the next resistance level would be, but then you have that level all the way up to 260 that we can hit without AI, without AI being figured out, and without a new iPhone. And then also think consumers aren't giving Apple credit in the wearables section as well. You have the watch that can communicate with your doctor. Who knows what other technological advancements that they can break through with that can perhaps maybe even be covered by insurance and become the gold standard in that industry. So they have a lot of tricks still left up their hat that's not baked into the price. So I like this long call options out to 2026.
The long call option there. Let's talk about the next one on your list. You've got Amazon on your list. It's been an underperformer year to date, barely got its head above the flat line. So what's your thesis here, Jason?
So I'm taking a different approach with Amazon. What I love about the company is that we can go to sleep at night and at least rest assured that the stock is not going to zero. They had a 13% year-over-year jump in revenue. They had an earnings beat of 27%. AWS grew by 17.5%, yet still the stock sold off over 20 points when they released their most recent earnings, as if they didn't have a beat on both EPS and revenue. Ad revenue also soared by 22%. So when you just look at the raw numbers and data, they had beats and increases across the board, yet the stock still sold off. So I'm looking at this one a little bit different. I think you want to own the stock here, but I like to get paid to try to buy the stock. So the strategy I'm looking at is you sell the covered put September 19th, 2025 with the 220 strike price. I picked that strike price because when you look at the chart, and I'm sure he'll walk us through the charts in a second, but that'll cover that most recent run up back to the gap down from when earnings had happened. And it's a stock that if you own it at 220 and you get a $5.50 credit, that brings your break even down to 250, which is down to almost a 200-day moving average where the stock sold off to. So I like this one as a get paid to potentially own it. And if you don't have to own it, you still get to collect the $5.50 premium or $500 per option contract that you sell.
Okay, so this naturally tees up KG. So KG, what do you notice about this chart, especially given what Jason's looking out for?
Yeah, it's had a pretty decent run from the lows here, but you are seeing a technical breakdown when it comes to the price action. In fact, if you look at the stock, it's below the 20-day moving average, which is in blue, and it's starting to trade well below that as far as a defined area of resistance. We haven't been able to recapture that now. You know, this time last year, what did you see? You saw an expanding megaphone pattern, a nice bullish uptrend after the stock hit that 200-day moving average, and that has been a key area of not only support but also resistance for this name. We saw that back in March where we tried to trade around it. We saw that breakdown. We had a double bottom type of pattern here, and we've been in the bullish formation ever since. But this channel that we pretty much have been developing since around middle of May or so has now broken, and also that once again that 20-day moving average has broken. You're looking at $210.50 as your first area of support. That's the 200-day moving average. Any breakdown below that, you're looking at $197, and any type of resistance, you're still looking at around $230 to $240 to the upside here until we may get some distribution happening for the name here. So I would be cautious around this one, starting to see some breakdowns here, but you would really get concerned if you break below that 200-day moving average. And so it seems like we might be on the trajectory of potentially testing that over the next couple of weeks or so. Let's see if some buyers actually step in and try to defend that level.
Okay, so some caution may be warranted. Does that line up, Jason, with the strategy that you're taking, and does what KG points out, I should say, confirm your approach?
Yeah, because when you think about it, if the 200-day moving average is support, that's around 212, 210 to 212. If we're selling the 220 put option, you're getting $5 for that. So that means you also have a $5 cushion. So the stock can fall down to 215, which is not that far from the 200-day where we believe buyers would step in. So worst case, you end up owning a great stock. Or if it doesn't pull back, which I don't suspect it'll pull all the way back, but if it doesn't pull all the way back, you still get paid for trying to pick up the stock at a discount, and we know it's not going to zero. So it pretty much supports the thesis that it's a safer trade versus saying, I believe the stock is going to go up. I'm saying I don't believe it's going to go down any further below the 200-day moving average.
Okay, all right, let's talk about the last name on your list, another member of the Mag 7 that's been more of a meh part of that group this year, Tesla, or maybe even worse than meh this year to date, not on a year-over-year basis. But so what's your view on this one and where it goes? Jason?
So Tesla, I'm looking at that very similar to Amazon. It's building the base around the $300 level. It's having resistance around 345, which is sitting at right now. They had the robo-taxi rollout in Austin. They are working on the lower cost Model 3. And then you also have the $7,500 EV tax credit getting ready to potentially expire. And so you may have orders being pulled ahead to take advantage of that tax credit, which may give Tesla a sales bump in the upcoming quarter. So I'm looking at this as being cautious. If that $300 level can hold, I say we look at selling the September 19th 305 strike price. Before the market opened, you were getting about $9 credit for that. It may be a little bit lower now that the stock is higher. But if you can get anywhere between a $5 to $9 credit, your break even comes down to about 296, which is right around that sideways channel of support. You're only in this for about 39 days. Again, worst case, you get paid for trying to pick it up at a discount. If you get to pick up the stock, then you can sell cover calls against it and you don't have to worry about options expiring on you. So you can wait and get paid to wait while we see how Tesla plays out.
All right, KG, speaking of seeing how Tesla plays out, what do you notice about this chart and how it's been playing out lately?
Yeah, it's been a nice little breakout to the upside here. We did see a pretty decent consolidation pattern over the last, say, month or so here, where the stock was making lower highs, but it was still keeping that area of support. And the reason why I bring this up, if you kind of go back and you see this kind of movement to the upside, it was very aggressive. Obviously, a lot of that was focused on the election. It was not able to actually hold that area. We saw some distribution between 380 and let's say 435 or so. And the stock went below that 200-day moving average. It acted as an area of resistance, and we started seeing a defined channel between 216 for the support and 292 for the area of resistance. We saw a breakout back in May above that 298-ish area, and this is where it has been able to flip from an area of resistance to an area of support, still making lower highs, but we actually had gotten fairly close to the apex here, and now we're breaking above that apex, breaking above the 200-day moving average, the 20-day moving average, as well as the volume point of control, which sits at around $323 right now. What are you looking at moving forward? If this trend's going to continue, you're looking at around that $380 level to around that let's say 430-ish as your next area of major resistance here, where some sellers could probably take a little bit of profits. But the RSI, once again, kind of breaking that formation, that downward formation right now, that's bullish. MACD crossing 12 EMA above the 26 EMA, that is also bullish here, Diane. This looks like this wants to try to at least test the 370-ish area, which you can make the case that was pretty much the highs that we saw back in late May here. And if it's able to break through that, once again, that gold zone. The last thing too, not technical related, but today a significant amount of options volume on Tesla, especially the 380 calls. Somebody's been buying a significant amount of those for the August 29th expiration. So that's another reason why you're probably seeing some enthusiasm on an intraday basis for this name.
Jason, I wanted to give the floor to you just for a quick final thought.
Final thought on Tesla, again, is similar to Amazon. Instead of trying to figure out where the stock is going to go, I like sometimes to look in this market where I don't think it'll fall below and getting that $5 to $9 premium. If it goes up, great. You just get to keep the premium. If it goes down, you get the stock at a discount and you have a little bit of cushion baked in. I think that's the ideal way to start thinking about options as the market is at all-time highs and struggling to break through. Play a little bit of defense, but have some offense in your corner where you're going to win, even if stocks don't go up.
All right. Thank you. That's Jason Brown of thebrownreport.com and our very own Kevin Green. Thank you both.